Can a 62-year-old couple with $2.3 million retire at age 65 while living their desired lifestyle in retirement? The initial plan said no, out of money in their 80s. But by adjusting just a few key variables, we got to yes, with money lasting well beyond their lifespan. If you're new to the channel, I'm Rosanna Quinan, a chartered financial analyst and founder of QuinVest. And after working with hundreds of retirees facing this exact question, I developed a planning system to help you confidently decide if and when you can retire. And that's exactly why I'm making this video today, to show you how to evaluate if your portfolio supports retirement and which planning decisions have the highest impact on your ability to retire at 65 if you're currently 62 years old with $2.3 million saved. So let's get into it. In order to answer our question, we will be looking at the case study of David and Susan White. So what we're looking at here is my planning software, Right Capital. And as you can see, David and Susan have about $2 million saved across a couple of 401k accounts, a brokerage account, and also a Roth IRA. What you will also notice is that the Whites have a house worth about $975,000, and they still have a mortgage on it of about $150,000. So they have quite a bit of equity in their house, which will come into focus later in the planning. So at age 62, David and Susan are thinking, when should we retire? Can we retire about 65 years old? That seems about right because Medicare will kick in at that point, so we don't have to worry too much about healthcare, and we are still both healthy and we want to spend some good years enjoying our retirement. They have estimated that they will need about $15,000 a month in retirement. Now, they haven't gone through a very detailed retirement projection or a budget, but this seems about right. It's a little less than what they live on. So one thing to know about the Whites is that they're avid travelers and they like to take a good big vacations every year. And they spend about $4,000 a month on those vacations. So about $40,000 a year for their travel budget. They both make healthy salaries, $170,000 and $150,000 respectively. And they do both qualify for Social Security, which at full retirement age for David is $3,400 a month, and for Susan it's $2,900 a month. So when we do this kind of analysis, we start with their retirement projections and more specifically with their cash flows, because honestly cash flows are at the base of everything that we're trying to decide in retirement. So let's look at their income. As you can see, while they're working for the next couple of years, they will enjoy their salaries, but then their income will completely stop and they will have zero income based on their work, zero earned income. Then the Social Security will kick in for both of them, which will make things a little easier. So that's on the income side. So what about the expenses? We have outlined that David and Susan will be spending about $15,000 a month in retirement. And you know what? This is an example. Obviously, your expenses will be higher or lower than that. And it's something that you need to work through for your own plan. But for the moment, it's a reasonable assumption. What you will also notice is that we have separated housing into separate bucket, into its separate category, because as David and Susan pay off their mortgage, the mortgage will go away, but there will be housing expenses that will still need to be modeled, such as their property taxes, their insurance expense, which keeps going up year after year, and house repairs and such, as far as their income and expenses go. And as you may be asking yourself, well, where is the money going to come from? And obviously, it needs to come from their retirement portfolio. So how much of their expenses will need to come out of their portfolio? And how will that go year after year? One thing you will notice is obviously their expenses go up with inflation and their needs, and there are no income to cover those needs until you can see that their withdrawals drop, because their Social Security will kick in and they will also pay off their mortgage in a few years. And you can also see that they have some tax payments coming through because they will be withdrawing from their portfolio, they will be incurring taxes. So at the first first glance, if we look at their retirement and we say, well, how does this look? Is this feasible? Can they do it? Can they retire at 65? And as you can see, it doesn't look very good at the first glance. But rather than panicking, we start looking at scenarios and saying, what is it that the whites can do to retire in the next few years? The most obvious place to go to say didn't retire at 65, but they did indeed retire at 68. How will that help their plan? So when we run these projections, we can see that, there is a significant chance of them making through retirement if they work for a few more years. But here is the thing. What we're going to do basically is have the whites work in the best years of their retirement while they're healthy, while they want to travel, while they want to enjoy their retirement. So that doesn't really look good from planning perspective. And if there is a way for us to avoid this scenario, we'd most definitely want to do that. So let's assume that they do want to retire and will retire at age 65. What are some other things that we can do to help the whites figure out this retirement puzzle, this retirement question? You will recall that we have this overall bucket for their expenses, which is about $50,000 a year. But you will also recall that the whites like to travel, and their travel expenses add up to about $40,000 a year. So in the current plan, everything is lumped together and we haven't separated travel out. But if you think about it, if you're retired for about 25, 30 years, if from your 60s to your 90s, is it realistic to assume that you will be traveling abroad, going to Europe or to the Caribbean, to all these fancy trips and hikes throughout your retirement? Probably not. So you'll probably, in your go-go years, you'll travel quite a bit, but then you will naturally slow down. So that expense will actually decrease. So why don't we go ahead and actually modify our goals to account for this change in the whites' goals and in their actual life? So if we look at the travel, we can set this travel amount for about $40,000, but rather than it going all the way through, we will just have it going one time. We will have it every 1 year for another 10 years. So once we set this goal to $40,000, then what we can also do, or actually before that, what I wanted to show you is before we make all of these adjustments, if we look at the whites' plan and we actually look at their retirement picture, so you can see that they start with their salaries and then their income goes up, then it goes down, and then eventually their RMDs kick in. But the whites are projected to run out of money in the current plan at age 82. So not a good picture and not a good place to be. And that's why we need to really put in some flexibility into our plan and figure out what is happening with the whites' plan. So what if we put $40,000 into their travel expenses for about 10 years and we reduce their living expenses to about $10,000 a month? 10,000, yeah. What will that do to their projections? You can see this alone will increase their probability of success by quite a bit. So, and if we look at the projected income, we can see that the proposed plan with this adjustment will have about $2.8 million more in ending assets, and they will not run out of money until for the entirety of their lifespan. So one thing I want to do is, the expression that the small hinges swing big doors, and same here with planning. The more thoughtful you are about your scenario, the more flexibility you will have. But you will also notice that small changes make big difference because these differences accumulate over time. And 30 years in retirement is quite a bit of time for these differences and for these changes to have quite a bit of an effect. Another thing we want to look at is this level of expenses that they have. As I mentioned, the whites didn't really go through a rigorous budgeting exercise. And what they assume is that their expenses will rise with inflation. But is that really true? Do the retirees incur expenses that just go up in a straight line and continue? And the answer is no. If you've heard about the retirement spending smile, you may know that when you first first retire, your expenses are high and they're probably pretty close to where you are right now. But then as your lifestyle changes and you slow down from your go to slow go to no go years, your expenses level out. And then at the end of your life, they will go up with long-term care, assisted living, and just more general expenses that add up for healthcare. So rather than assuming just one way of looking at expenses, what if we change these inflation-adjusted expenses to actually looking at a retirement spending smile for David and Susan? And let's see what happens in this case. And you can see that their projection will actually go up to 70%, which is getting us closer to where we need to be. And it looks to be that there is a few other levers that we should pull to make sure that their plan is solid. What I like to see is at least 80% probability of success. So 70% is still not at where it's supposed to be. At that point, we haven't looked at their investment strategy at all, which we will not do in too much detail in this video, but their current allocation is moderate. So what if we modify their allocation to something that is more thoughtful, and that would increase their chances of success even more. So another lever we can pull is actually, what if we downsized to Florida and figured out that if Florida doesn't have income taxes, they can sell their house, use the equity to add it to their portfolio, and have another chunk of investments to help them in retirement. So these are all levers that we can pull to help the whites retire with more confidence. Here is the point. If you're asking whether you can retire in your 60s when you have a couple $1 million saved, the answer is probably yes. But the bigger question isn't whether you can retire. It's how much you want to spend and what you want your lifestyle to actually look like. And that answer is very different for everyone. It depends on where you live in the country, what your habits are, what potential expenses you may face, and how much flexibility you want to have in your lifestyle. So the most important question becomes, what does your cash flow look like? How do you convert your portfolio value into an actual income stream? How do you stack all your sources of income, Social Security, pensions, business sale proceeds, inheritance, real estate income, you name it, on top of your investment assets to create a full picture of your income flows through retirement? And then, how does that income compare to the expenses you'll be incurring every year? Just as important, how will your expenses change as your goals change? What if you want to travel more in your early retirement years? Or what if you want to help your grandkids with college, or pay for a wedding, join a country club, or even make significant donations to the causes you care about? This is why having a comprehensive plan that shows you how much income your portfolio can generate compared to your actual desired expenses throughout retirement is what gives you real clarity. That's what allows you to confidently determine when you can retire with your level of assets. So that was David and Susan's plan. By testing different variables, when they retire, how they allocate spending, and a few other key inputs, we went from a plan that failed around 80s to one that works well beyond their lifespan. What about your plan? Do you have all the answers to your own retirement? When we work with retirees, we always answer two critical questions first. How much income does your portfolio actually need to generate each year in retirement? And are you on track to hit your spending goals, or will you fall short? If you want these answers for your own retirement, click the link below. Fill out a quick form, and I'll get you your personalized 5-minute video plan showing your numbers, your withdrawal rate, and whether you're on track within 48 hours. Thanks for watching, and I'll see you in the next one.